Business English News, Silicon Valley Bank, and more M&As ahead. Greetings, colleagues. What's going on with Silicon Valley Bank? Should we expect more mergers and acquisitions coming up? Want to improve your business communication? Looking to enhance your business English skills? Let us go through this article together, review the vocabulary, and discuss. Welcome to the rundown. Let's level up your business English. All right, let's jump into the article. This is from the Wall Street Journal, which if you're not familiar with, of course it's published on Wall Street, in the heart of the financial district in New York City, and it's probably the premier financial newspaper in the United States. The title of the article, SVB Collapse Could Trigger More Corporate M&A, Tech Leaders Say. Subtitle, I think we're going to see corporate buyers, particularly CIOs and tech leaders, get into this. Forrester's Baloras says. SVB is Silicon Valley Bank, and a lot of people, including myself, have never heard of SVB until the last month or so, but now it seems like that's all we hear about is SVB. Silicon Valley Bank is in Silicon Valley in California. The collapse. So collapse is when something falls apart, and so here we mean bankruptcy or bank runs. We might talk about that later, but a bank run is when the depositors of a bank go to that bank and try to take out all of their money, try to get cash for all of their deposits because they don't trust the bank anymore. They think, okay, the bank is going under, it's going to collapse, it's going to go bankrupt. So what is the best thing I can do? Get my money out right now. I don't want to wait until some people take out their money and then there's no money left in the bank vault. So that's what often causes bank runs. People lose credit or faith in the bank. And even if the bank was okay before then, if everyone tries to take out the money, the bank is not going to be okay. And that will lead to bankruptcy. So it could trigger. Trigger we might think of in a pistol or a rifle, pulling the trigger sends the round down range. But here we mean more of a metaphor that like pulling this trigger causes this consequence, causes this reaction or action. Corporate M&A. M&A is the term for mergers and acquisitions. This is when two companies merge together and become one. Now, whether they merge or maybe the bigger company buys the little company, they acquire the little company, and then the little company kind of disappears, but it's the same legal process or business process. It doesn't really matter if it's two companies about the same size merging together or a very large company and a very small company. It's the same process. And so often we call that M&A, mergers and acquisitions. So there are some lawyers and business experts that this is their specialty, this is their field. They only deal with M&A. There's lots of moving parts with that. There's lots of legal issues and other issues that are involved. So they make it their specialty. All right, let's scroll down. So here's Silicon Valley Bank. So the caption underneath that photo, Silicon Valley Bank offered banking services to startups that often weren't profitable and would otherwise have a hard time getting a line of credit or a loan. And that kind of makes sense, right? It's in Silicon Valley. It's where a lot of those tech startups, begin. What is a startup? A startup is a brand new company that is starting up. It's just beginning. And often the tech startups, they might have some financial backers. They might have been from a larger tech company themselves before they started this smaller startup, but they're not very successful yet. They're just starting up. So maybe you want to invest in them because maybe it'll make you a billionaire, but maybe nothing happens. They never really get their technology going, or they really can't find the niche. Maybe a bigger company gets that technology first or is able to mass market it. For whatever reason, the startup just kind of fizzles out. So obviously it's going to be risky. Every startup is going to be risky. And of course, when they begin, most companies when they begin are not profitable. They're not making more money than they're spending. Their expenses are going to be a lot higher than their revenue. So they're not profitable. They're not making a profit. They're losing money. This is normal in a new company. A line of credit or a loan. So a line of credit is kind of a type of loan. Normally we think of a loan as you go to the bank, they give you a sum of money or add it to your account, and then you're free to use that money. But of course, you're paying off the interest, you're paying off the principal, usually on a monthly basis. A line of credit is really a contract for a loan or a series of loans. For example, if you get a line of credit for $1 million, you can use that $1 million or up to that $1 million whenever you need it. Maybe you don't need it today, but sometime during the year you're going to need some money. So you want to come to terms for a loan right now while everything is good. Now, maybe next month or 6 months from now, you need $100,000. You don't need the full million, but you need the $100,000. You have that line of credit. You can take out that $100,000. Of course, once you take it out, you have to pay principal and interest on it. And of course, you have to repay it as you go. But you still have $900,000 line of credit that you can still call upon. Maybe the next month you need to take out another $200,000. You can do that. Of course, you're still paying principal and interest on the loan that you've already taken out, but you can take out more because you still have that line of credit. Maybe the following month you pay off that $300,000 that you borrowed, plus the interest, of course. Now you still have your $1 million line of credit. You paid off the money that you borrowed, and now you still have that line of credit. You can borrow up to that full amount, that $1 million. They often call this a revolving line of credit, just like a revolving door that spins around. You can borrow some money from the bank, pay it off, and then borrow more money, pay it off, borrow more money, pay it off. For a lot of companies, this is a necessity because some months they're going to get paid more than other months. Maybe there's lots of expenses this month and not a lot of revenue. But in a couple of months, there's lots of revenue, maybe not a lot of expenses. They can pay off some of that loan or all of that loan. But to get through the normal cycle of the ups and downs of their business, they rely on that line of credit. So it's very common for businesses, especially big businesses, big companies, to have a line of credit or maybe multiple lines of credit. Let's jump into the article itself. We see that's written by Isabel Busquet and Stephen Rosenbusch. The increasing pressure on venture capital investing from the collapse of Silicon Valley Bank and other macroeconomic factors could spur a pickup in technology-focused corporate M&A, according to business technology leaders. So venture capital or venture capital investing, these are the money men or money men and women that will invest in these startups. It's venture capital meaning the investment, and venture kind of like adventure. There's a startup, it may make it big, it may collapse, but we're willing to take a risk, we're willing to invest in that. So maybe they need a lot of capital, a lot of money to get started. So the venture capitalists will invest, they'll provide that capital, that investment to get the company rolling. They're thinking it's going to pay off, but of course it might go bankrupt. Macroeconomic factors. So this has to do with the whole economy, not necessarily Silicon Valley Bank or the business of any one company or even region, not necessarily Silicon Valley as a region or the tech industry as a whole, but the whole economy. For example, a company may be doing very well, but there's macroeconomic factors that are against it. The whole economy goes down. So this company, although it was doing well, the economy went down, and so they went out of business. Not really they did anything wrong, just the economy was kind of against them. It was, they couldn't survive this recession or this economic downturn. So macroeconomic factors would be something that an individual bank or a company really wouldn't be able to control at all. It's outside of their influence. In the title itself, it said CIOs, and I think I didn't mention what that was, but it's in this next paragraph. This could present both opportunities and challenges for Chief Information Officers, CIO. So often the CIO is basically the top person regarding information technology. Let's continue further down. I'm going to skip ahead a little bit. Corporate buyers globally struck 44,377 merger and acquisition deals last year, up from 40,403 in 2021, according to market analytics from PitchBook Data Inc. In 2021, we had over 40,000 mergers and acquisitions. In 2022, over 44,000. So that's about a 10% increase. So that's a pretty sizable increase. We're into the first quarter in 2023. So what do we think? Is that increase going to keep going, or is it going to go back the other way? Let me know what you think. Skip ahead a little bit here. Post SVB, the pace of corporate M&A could increase as VC firms display a natural tendency toward creator caution, according to Stephanie Baloras, Vice President and Group Research Director for Cybersecurity, Risk, and Enterprise Technology at research and advisory firm Forrester. So post SVB, what does that mean? Means after SVB. What do we mean by after SVB? Well, SVB collapsed. They have this huge bailout that's going on. So after this incident, after SVB happened, the pace. What is pace? Pace is the speed or the tempo. We can think about a runner. A sprinter is going to have a very fast pace. They're running as fast as they can. A marathon runner is going to have a much slower pace because they're running a much longer distance. So their speed, their tempo, their pace is going to be much slower. So here they're saying that after SVB happened, the pace of this corporate M&A could increase. As VC firms, what is VC? We talked about it before, venture capital. So there are some firms, some company that are venture capital companies, venture capital firms, VC firms. So what do? They look for startups that look good to them. That, wait a second, that's a good idea. That's some really good technology. We think that there's a future in that, so we want to invest some money into it. So if you have a startup, you probably want to find some VC firms that believe in you, that want to invest in you. It's going to make your job starting as a startup much easier. And let's continue in the article. Quote, I think we're going to see corporate buyers, particularly CIOs and tech leaders, who have come to rely on startups in the tech sector, particularly if they have not thought of themselves as acquirers, get into this, unless they want to see startups they have come to rely on fail, close quote, she said. Corporations may need to acquire financially vulnerable tech startups that have become integral to their technology infrastructure. Corporations also may seek to acquire small tech firms to press their competitive advantage, according to Ms. Baloras. So what is she saying here? She's saying because some of these startups might go out of business because of everything that's going on, some of these macroeconomic factors, some of the companies that they never thought themselves as acquirers, their company is not in the business of acquiring other companies, but they're going to start doing this because maybe they rely on these companies. Maybe it's a larger company that uses this tech of a smaller company, of a startup. And then, if this startup or this smaller company goes out of business, that's going to hurt the big business, the big company. So the big company is going to think, wait a second, maybe we should just acquire this small company. Maybe we should acquire this startup so that it doesn't go out of business and we're not negatively affected when it does go out of business. And also, maybe it's a competitive advantage. Maybe if we acquire this technology, this company, the resources of this company, it's going to help our business, but it's also going to provide us an advantage over our competitors. So maybe that's what we want to do as well. Skipping ahead, Wendy Pfeiffer, Chief Information Officer of Nutanix, Inc., said that after the collapse of SVB, she began considering, quote, are there opportunities for me to maybe invest in a partner and make sure that they're there for me, close quote, which is exactly what we just discussed, right? Maybe there's a partner, they're doing business with this company, the smaller company, but if they go out of business, it's going to be bad for them. Maybe we can partner with them, we can invest in them, and make sure that they don't go out of business, that we don't lose that business partner, in other words. Corporate M&A activity provides CIOs the opportunity to beef up their information technology stack and bring on new talent. Conversely, that can also mean they lose a core piece of technology if one of their vendors is acquired by another company. So a vendor is basically a supplier, a company that does business with you and either supplies you goods or services. So when it's talking about technology, it's not so much, it's probably not goods, but it's services. Maybe they provide servers, they provide information technology services, they provide cybersecurity or other things. So we don't want to lose our vendors because if they go out to business, we need to find new vendors. Now, maybe it's just a brief disruption. Okay, they went out of business, we'll go to the next one, and it's not much of a problem. But maybe we spent a lot of time integrating with this first company, with this vendor. We know how they operate, they know how we operate. It may not be so simple just to cancel a contract with one and start a new contract with another company. So maybe they want to acquire that smaller company so that everything continues smoothly. There's no disruptions in service. Let's continue. Skipping ahead, for many CIOs, the decision to build or buy technology is often made when considering new IT solutions, said Mike Anderson, Chief Digital and Information Officer of cloud security startup Netskope, Inc. At those decision points, CIOs shouldn't shy away from the product innovation offered by technology startups, he said. So build or buy, what does that mean? In this context, let's say that bigger company is deciding, we need this service, we need something, we need to use technology to do this thing, this process. Should we buy this as a service from another company, or should we have our IT people figure it out and develop it themselves? Now, obviously, if it's something that's already been developed, that already exists, maybe it's easier to just buy it, to buy it as a service from the existing vendors that are available. But if it's something brand new, well, gee, we could have a vendor develop it for us, but maybe we should just develop it ourselves, in-house, internally, and then we would own that technology. If somebody has to build it from scratch, bespoke just for us, customized, tailored just for us, then maybe our company should do it, not have another company do it. Then we won't own it. Maybe they go out to business, maybe they start charging us more money, whatever the situation. Maybe we just want to build it ourselves, or or if a vendor already built it for them, maybe they want to end up buying that vendor, so it becomes part of that company. Let's move on. One final quote. When you're in a market like this, people are often more eager to give you better terms, close quote, Mr. Anderson said. So if this is what the market is, maybe you're going to get better terms when you start the M&A process. Now, we didn't really talk about this, but sometimes mergers or takeovers, we can also call merger, acquisition, or sometimes it's called a takeover. And sometimes we also define it as a hostile takeover. The company that is being taken over, the company that's merging or being acquired, doesn't want to be acquired. And it's much more difficult to take it over if they're resisting, if it's a hostile takeover. A recent example of this might be Twitter, where Elon Musk wanted to take over Twitter. And I wouldn't say it's completely hostile takeover, but certainly it went back and forth. Sometimes Twitter, the board wanted to be taken over, sometimes they didn't. Then they ended up kind of suing or threatening to sue Elon Musk, like, you promised to take us over, you better complete the deal. But it went back and forth whether it was hostile or not. But certainly there were elements of a hostile takeover throughout that process. Now here, Mr. Anderson is saying that it's probably not going to be a hostile takeover, and therefore it's going to be a little bit easier. They're going to give you better terms, because if it's a small company, a startup, that especially if the economy is going down, maybe they want to be taken over. They want to be part of a bigger company because they think they're going to be more stable because of that, which may make sense. Hopefully this article was interesting for you. We discussed a lot of terms with this, so I think it was a good article to go through. What are your thoughts on Silicon Valley Bank? Let me know in the comments below. The next video is about useful terms in business meetings. So click on that and check it out right now. But before you go, conquer that like button and make it ours. Work hard today and enjoy tomorrow.